What's up, you guys? Welcome back to the channel. Now, you guys know that the EV industry has really been taking a big hit lately, and they've been on this big downwards trend for about the last month or so. But in today's video, I want to go over if this is potentially the bottom and if we're going to finally start seeing the EV industry start climbing back upwards. I'm also going to touch specifically on Tesla and Churchill Capital stock and why both of these stocks could look like a good buy right now, and why you may want to consider buying into either one of these stocks at some point in the near future. And also specifically to Churchill Capital stock, or Lucid Motors stock if you want to call it that. They also had a big achievement and a big milestone that they actually hit, and this could be a big catalyst to push their share price up. But before we actually get into the details, for those of you who are new here, my name is Evan, and I make videos about different hot stocks that have a lot of high growth and a lot of growth potential. So if that interests you guys, make sure you subscribe and hit the notification bell so you never miss when I upload. Also, if you guys do enjoy these types of videos, make sure you go down and hit the like button, because it really does help out the channel and it lets me know that you guys enjoy these video updates every day. Now, starting off here with Tesla, they're actually up almost 20% on the one-day chart. And if you guys have been following along with the EV sector, you know that it's really been tanking lately, and Tesla has really not seen any green days lately. Obviously, with them being in the green today and being up over 20%, a lot of people are asking why they skyrocketed so much today. And there's actually a few reasons. Now, number one is that there's actually positive developments towards the vaccine front, and a lot of investors have actually rotated out of high-priced growth stocks, and they're looking for more bargain price stocks that could benefit from a post-pandemic economy. And this refers to different stocks that are going to recover with the economy after the pandemic. And Tesla was actually caught up in this rotation after they actually climbed to a record of $900 back on January 25th. Tesla's lost more than a third of their valuation by March 8th. And there's also a new street analyst that thinks now is a good time to buy Tesla shares. And he also raised his rating on Tesla stock from a neutral to a buy on Tuesday. He said that he sees Tesla stock climbing to $900 as they ramp up manufacturing capacity and as they quadruple deliveries of their popular EVs over the next 3 years or so. And then Wedbush analyst Daniel Ives also said today that he believes Tesla stock price could reach as high as $950. And his price target represents a potential gain to investors of roughly 50% from Tesla's current price, and at the time of this article was $630, and now they're already up to over $670 at the time of recording this. And I'm sure for those who have been following along with Tesla, you're probably aware of ARK Innovation and their innovation ETF, which is ARK-K, and this is led by CEO Cathie Wood, and she believes with this big sell-off, and while it's overdone, she thinks now is a good time to scoop up more shares of Tesla, and that's exactly what ARK has been doing. They've been buying more shares at this significant discount compared to Tesla's recent highs. Now, moving on to Churchill Capital stock, because I think we can all agree that a lot of people are very bullish on Tesla, but that's maybe not the case with Churchill Capital stock. And a lot of people still think that Churchill is very overvalued, even at $24 to $25 that they're trading for right now. And actually on the one-day chart, they're up almost 11%, trading right at $24.50 or so. And this big price increase we're seeing today could be due to a couple things. Now, one of those things is that big milestone that I mentioned earlier, and we're going to touch on that in a bit. But of course, one of the other big catalysts pushing up Churchill's price is Tesla's movement, because Tesla is pretty much the benchmark when it comes to EV stocks. And as Tesla moves up, of course, all these smaller EV stocks are going to move up as well, because they're very reliant on Tesla's share price. So that's definitely a big factor affecting Churchill's price today. But aside from the upside that we're seeing today, overall, they've really had a big downtrend in the last couple weeks. And this is after the announcement of the merger between Churchill and Lucid Motors. But as this bubble has been deflating, which we can all agree that Churchill really was in a bubble and they were just being hyped up. But as they start to deflate, their stock is really getting interesting, and there's really been a lot of people loading up on Churchill stock. So I think going back to the merger information and when Lucid and Churchill actually announced that they're going to be merging, I think there was a lot of confusion and a lot of new investors who weren't sure exactly what was going to happen, because the closing price was actually above $57 on February 22nd, and that was the day the merger was officially announced. And some of the information that was available to the market at the time suggested that Churchill Capital stock and their valuation was way too high. But I think there was too many investors who didn't know exactly how a SPAC worked. and that a SPAC basically just raises money to bring a company public. Too many of these investors were buying Churchill because they liked Lucid Motors, not because they were interested in Churchill Capital, and they either didn't quite understand or they chose to ignore the valuation of the stock, or the fact that Churchill only would receive an unspecified portion of the equity in Lucid. And so the fact that Churchill stock has fallen from $63, which was their intraday high on the 22nd, all the way back down to $22 or so, this doesn't make their stock cheap. And it also doesn't mean that short sellers or the Saudi private investment fund are manipulating this stock. And there's also been a lot of complaints that the company leaked incorrect information before the merger. Now, obviously that was to benefit their PIPE or their private investment in public equity, who invested alongside the SPAC merger at a price of $15 per share. And then of course, short sellers are also always to blame, but the short interest on Churchill Capital was actually very minimal. It was barely 2% of the float. And also some of the activity may have been hedges against owned warrants in Churchill Capital stock. So considering all of this, I want you guys to understand that their stock wasn't being influenced by outside sources, and this was all just due to their stock simply running too far. The trading on Monday, February 22nd was insane, and Churchill actually had gained 19% in intraday and closed above $57, up 8.4%. And we even had information suggesting that this rally was crazy. For example, Bloomberg actually reported that weekend that a deal was near and at a valuation of $15 billion. This also followed earlier news from a sighting at a $12 billion valuation. Yet at $57, Churchill themselves had a market cap of nearly $11 billion. This did include warrants of their $3 billion plus in cash, which was being valued in the range of $16 billion. So there's really no way to support their price that they were trading at, and a $60 plus share price for Churchill Capital really was due to have a correction at some point. But of course we know that Churchill Capital is no longer trading at those insane rates, and they're actually coming back down to earth, and they're trading right around $20 to $25. Now there is a case for buying the dip of Churchill Capital stock, and I think there's a lot of reasons you may want to consider adding some shares to your portfolio. Now I do want to say that I'm not a financial advisor, and nothing I say should be taken as financial advice, but there's definitely a bullish case for Churchill Capital stock, especially with them trading under $25. So if you guys know anything about Lucid's cars, you actually know that they claim to have a better range and better performance than Tesla, and they also have their own platform that can support launches of additional models. And their CEO, Peter Rawlinson, was actually an engineer at Tesla, and he worked on the Model S. And he said in February that Lucid is going to mimic Tesla's strategy. So exactly what that means is that Lucid is going to start out with the luxury market and then expand from there and make their vehicles more feasible to attain for normal customers who aren't in the luxury end of vehicles. And they're also going to go with a direct sales model, much like what Tesla's doing. So these attributes are the core of the case to buy Churchill at $22. And at $22 with a pro forma valuation excluding cash, they're currently closer to $30 billion, excluding cash on the balance sheet. And of course, that valuation is a little easier to swallow than when they were trading at $57 just a few weeks ago. Now, of course, there's also downsides and risks to buying Churchill right now. And a lot of times when we see SPACs and when they finally merge, oftentimes they actually do pull down quite a substantial amount. The only difference with other SPACs that we've seen in the past and in the recent past is that a lot of times they've actually been hyped up. Now, I'm not saying Churchill wasn't hyped up, but they've pulled back down to earth, and they're not at these insane highs like $57 that they were trading for. If they continue trading between $20 and $25, they're not going to have as steep of a fall when they finally do merge. But I definitely want to give you guys both sides of the story and let you guys decide if this is a stock you want to buy in, or if this is a time you want to add more shares if you're already investing in them. But right now, it's hard to imagine a better example of a falling knife than Churchill Capital stock. Recently, they've just continued going down when you exclude today's trading. So if you exclude today, it's just been this constant downwards trend. Now they might finally be starting to recover, and the EV industry might start finally going back up. But there's definitely still a sentiment problem and argues for short-term patience. But this does create a long-term roadblock. And so you combine the fact that they're currently a falling knife. Obviously, you might get cut if you catch a falling knife, but that's part of the risk when buying into stocks like this, is that the upside potential is really there, and long term, a stock like Lucid, while they aren't super established right now, if they actually continue growing and their company continues achieving these different milestones and they actually put out the technology that they're talking about, I don't see why they couldn't compete with Tesla down the road and really give Tesla a run for their money. So again, that is the risk when you're investing in a company like this, and you really never know when they're going to turn around. This could have been the bottom right at $22 or so, but there's just no guarantee how far Churchill's really going to fall. So that's kind of a quick rundown of different reasons why you may want to invest in Lucid Motors, which is currently Churchill Capital stock, and a couple of reasons why you may want to avoid them. I'm just giving you guys both sides of the story, and you guys are going to have to make the decision if this is a risk you're willing to take, and if it's a company you potentially believe in long term. Now, like I said at the beginning of the video, Lucid Motors actually achieved another milestone, and this is one of those things that could potentially make their shares look pretty attractive at the discounted price that they're trading for right now. Now, the reason why I left this out between the argument of whether you should or shouldn't invest in Churchill Capital is that this isn't really going to have much of an effect on Lucid Motors, and this is mostly because there's two parts of this news. One thing's negative and one's positive, and so they do kind of cancel each other out. So the first thing that's kind of negative is that Lucid Motors actually had a setback, and they announced a delay of their official launch of their electric vehicles, and they're not going to release them until the second half of 2021. Now, while this isn't necessarily super negative for Lucid Motors, I think it does let down a lot of investors and potentially a lot of customers who were going to buy their vehicles and were expecting them to be delivered in the spring of 2021. Now, of course, we've seen Tesla have a lot of dates set in mind for different releases of products and different vehicles, and they've let people down quite often. But I think Lucid is trying to be a step above Tesla, and so to see them already have a setback and a delay, I think that's where you kind of get some negativity, and a lot of investors don't really like to hear that. But for the good news, as per the reporting by Casa Grande Dispatch, Lucid Motors now procured the requisite approval from the Planning and Zoning Commission to begin Phase 2 expansion of their manufacturing facility. Their facility currently consists of two buildings that cumulatively occupy 820,000 square feet. Phase 2 is going to add another 2.4 million square feet in manufacturing space. And the reason why this is so crucial is that it's going to allow Lucid Motors to be able to increase their manufacturing capacity from 34,000 units up to 90,000 units per year once the Phase 2 expansion is complete. And the Lucid powertrain manufacturing plant is also located in Arizona, and this facility is where they're going to manufacture the electric powertrains, battery modules, and their management systems. And they're also in the talks of establishing another manufacturing facility in Saudi Arabia. So I think this is definitely good news for Lucid Motors and for those who are investing in Lucid Motors, because once they actually start producing vehicles and getting them out to customers, this could potentially be something that's going to push up their share price and really increase their overall business model. But as of right now, with this delay of their vehicles, they really can't take advantage of this increased capacity. And so that's why I don't think it's necessarily a positive catalyst as of right now. I think down the road, this definitely is going to help Lucid Motors, and it's going to garner a lot more investor interest. So before we actually wrap up this video, for those of you who made it this far, I want you guys to leave a comment down in the comment section and let me know if you guys are actually investing in either Tesla or Churchill Capital stock. And if you aren't, let me know why you think that these aren't a good investment right now. And if you guys haven't signed up for Webull, make sure you guys sign up using the link in the description. And when you sign up and deposit $100, you'll get 2 free stocks and I'll get 1 free stock, and it really helps out the channel. So make sure you guys sign up while this offer is still available. And if you guys enjoyed the video, make sure you leave a like, subscribe, and hit the notification bell so you never miss when I upload. And with that said, thank you guys so much for watching, and I'll see you back here in the next one. Bye.